It is 6:37 p.m. I should not be filming this right now. But I am filming this right now because in the last 6 hours, something happened in this market that is so significant, so deliberately hidden from the average investor, that if I wait until morning to explain it to you, the move will already be over and you will have missed it completely. Silver, $81.42, down 4.43% today alone. And the reason it dropped has nothing to do with anything Bloomberg told you. Let me tell you exactly what happened today. And more importantly, let me tell you what is happening right now while Wall Street sleeps and Bloomberg runs its midnight reruns. 12 months ago, silver was trading at $30 an ounce. $30. Your financial advisor probably told you it was a dead asset, a speculative relic, something conspiracy theorists bought and kept in safes. And then the world changed. By January 29th of this year, silver hit $121.67 per ounce, a nominal all-time high, driven by a convergence of forces so significant, so structurally serious, that the price move was not a mania. It was a message. A 170% year-over-year gain is not irrational exuberance. That is a market screaming that something is fundamentally broken in the system underneath it. And tonight, 33% below that peak, the same forces that drove silver to $121 are still active. They have not resolved. They have not been addressed. They have simply been temporarily overwhelmed by institutional liquidation, a strengthening dollar, and the mechanical selling that follows whenever the Federal Reserve refuses to blink. But the underlying architecture, the supply deficit, the geopolitical stress, the industrial demand that cannot be turned off, that is still here. And Beijing knows it. Let me walk you through the 4 stories that created today's price and are going to determine where silver goes in the next 6 months. Because these are not separate events. They are one event, playing out across different markets simultaneously. Start with NATO, because that is where the institutional money started moving first. For the past 18 months, the alliance has been operating under a level of internal fracture that portfolio managers cannot ignore. The debate over defense burden sharing, over the reliability of Article 5 commitments, over whether the security architecture that has underwritten global dollar dominance since 1949 is still intact. These conversations are no longer happening in think tanks. They are happening in the treasury departments of sovereign wealth funds. And when that kind of uncertainty enters the room, capital does not sit in bonds. It does not sit in cash. It moves into assets that exist outside the political system. It moves into gold. And because gold at over $3,000 an ounce prices out certain buyers, it moves into silver. That is not speculation. That is the documented flow pattern of every major geopolitical stress event of the last 50 years. 1973, 1979, 2001, 2008, 2022. Every single time the security architecture wobbles, real assets catch a bid. This cycle is no different. The NATO anxiety trade of late 2025 and early 2026 is a documented, measurable contributor to silver's run from $30 to over $100. COMEX open interest, which tonight sits at 77,600 contracts, built up during that period as institutional money piled into the trade. Then the Trump administration handed the market a second catalyst, and this one was more mechanical, more immediate, and ultimately more destabilizing than the geopolitical backdrop. The tariff decisions of early 2026 created what commodity analysts call a supply dislocation event. When Section 232 tariff threats were applied across metals categories, industrial consumers and traders did the rational thing. They panicked. They rushed to stockpile physical silver before the tariff wall made it more expensive or less accessible. COMEX registered stocks, the silver available for physical delivery, began tightening at a rate that alarmed anyone watching the delivery data. Physical delivery stress, the measurable gap between paper contracts and available metal, started rising. And the price responded exactly as it should when genuine demand for a physically finite commodity exceeds available supply in a compressed time frame. It went from $30 to $121 in under 14 months. U.S. Treasury Secretary Scott Bessent publicly acknowledged the extraordinary speed and scale of the move, pointing to it as evidence that forces beyond normal fundamentals were driving the market. He was right. But the force he was describing had a specific origin point, and it was not entirely organic. Because while the tariff panic was driving Western buyers to stockpile, Beijing was watching every single data point in real time. China is the world's largest silver-producing nation. It is a dominant player in the silver-dependent manufacturing supply chains, the ones that feed solar panel production, semiconductor fabrication, and electric vehicle systems. China did not need to manufacture a silver crisis. The United States handed them one by creating artificial scarcity through panicked, tariff-driven hoarding, and then Beijing did what any rational state actor does when its rival hands it an advantage. It used it. On the Shanghai Futures Exchange, silver activity surged in ways that were directional and deliberate. The SHFE silver price moved into a premium over COMEX, a spread that does not develop at that magnitude in a normally functioning global market. It develops when one side of the market is absorbing supply faster than the other side can replace it. Simultaneously, export restrictions on materials that silver-dependent industries rely upon began tightening. The message was not ambiguous. This was an economic counterpunch, calibrated to exploit a commodity market that the United States had already stretched beyond its normal operating parameters through its own policy decisions. And it worked. Silver hit $121.67, and Wall Street was long. That last sentence is why tonight matters. When silver was climbing through 80, through 90, through $100, the institutional trade was crowded and it was profitable. Hedge funds, commodity desks, family offices, everyone wanted exposure to the story because every angle of the story pointed up. The geopolitical safe haven narrative, the supply deficit narrative, and understand this is the 6th consecutive year that silver demand has exceeded mine supply. 6 years of structural deficit. The industrial demand narrative, where 60% of annual silver consumption now goes into solar panels, electric vehicles, and semiconductors. Industries that are growing, not shrinking. Every data point, every macro signal, every supply model said the same thing. Buy silver. And so they bought. They bought futures. They bought ETFs like SLV and SIVR. They bought mining stocks levered to the price. They bought physical silver and moved it into American vaults partly out of conviction and partly out of fear that if they waited, the metal would not be available at any price. 77,600 open interest contracts on COMEX tonight represents the residue of that crowded trade. And then the unwind started. And this is where we are right now, at $81.42, watching it happen. When silver hit $121, the risk-reward calculation began shifting. Profit-taking from early longs created the first wave of selling pressure. Then, the dollar strengthened, which is its mechanical response to global uncertainty as capital repatriates toward perceived safety. And a stronger dollar is a structural headwind for every dollar-denominated commodity without exception. The Federal Reserve held rates steady in March, as the market had expected, but the hope for aggressive and rapid easing, the kind of monetary loosening that historically supercharges precious metals, faded with it. Right now, only 60 basis points of rate cuts are priced in for the rest of 2026. That is not the liquidity environment that sustains a parabolic move in silver. So the funds that bought at 90, at 100, at $110, they are underwater. And institutional players who are underwater on a crowded trade do not hold and pray. They liquidate. They liquidate to manage risk, to meet redemptions, to stop the mark-to-market bleeding on their books before their quarterly letters go out. And that forced liquidation creates exactly the price action you are seeing on the chart tonight. 4.43% down in a single session. A bearish engulfing candle forming on the weekly chart, one of the most reliable reversal signals in classical technical analysis, confirming that sellers have taken control of the short-term structure. The key support zone sits between $78 and $80 per ounce. That is the next line that matters. JP Morgan's full-year average forecast for 2026 is $81 per ounce. We are at $81.42. We are sitting directly on the bank's consensus price, which means the market has already priced in the bearish scenario most institutional analysts expected. What happens next depends entirely on which force reasserts itself first. And here is what the 7-day algorithmic forecast is saying right now. The model is projecting $81.18 by March 23rd, a 0.84% move that is technically classified as mildly bullish, but is essentially flat. The algorithms see equilibrium. They see a market that has absorbed the selling pressure from overleveraged longs, but has not yet found the catalyst for the next directional move. That catalyst is coming. The question is, which direction it arrives from. There are three realistic scenarios playing out over the next 3 to 6 months, and you need to understand all three of them clearly before you make any decision about this market. The first scenario, the one the technical picture currently favors, is a continued correction that sweeps the $78 to $80 support zone before finding a genuine floor. In this scenario, the remaining overleveraged longs get completely flushed out, open interest contracts sharply as weak hands exit, and silver enters a period of base building at lower prices that could last weeks. This is actually the healthiest outcome for the long-term structural bull case because it resets positioning, eliminates the speculative excess, and creates a cleaner foundation for the next move higher. If 78 breaks on meaningful volume, do not be surprised to see silver test 75 before any serious recovery begins. That would represent a 40% decline from the all-time high, deep enough to shake out virtually every recent buyer and reset sentiment to the kind of extreme pessimism that historically precedes major reversals. The second scenario is a sharper recovery toward $90 than most participants currently expect, triggered by catalysts that are sitting right on the edge of probability. If the Federal Reserve signals a faster path to rate cuts, perhaps in response to the weakening U.S. retail sales data that has already been coming in soft, the dollar softens and real assets catch an immediate bid. Every 25 basis point signal of dovishness adds a tailwind to silver's price in dollar terms. Alternatively, if tariff policy escalates in a way that reignites the physical stockpiling trade we saw in early 2026, COMEX registered stocks tighten again, and the supply dislocation premium returns to the price with velocity. $90 on a policy shift is not an aggressive call. JP Morgan's own forecast, which shows an $81 average for the full year, mathematically requires a significant second-half move if the first half stays near current levels. The numbers support a recovery toward 90. The timing is the unknown. The third scenario is the one that the fundamentals keep pointing toward, even when the short-term price action argues otherwise. 6 consecutive years of supply deficit, mine production that has structurally failed to keep pace with industrial demand, 60% of annual silver consumption going into industries that are not cyclical. Solar panel installation targets are set by governments, EV adoption curves are structural, semiconductor demand is inelastic at the margin. That demand does not disappear because a hedge fund in Connecticut needs to de-risk its book. It compounds, it persists, it grows. And if geopolitical stress continues, if the NATO fracture deepens, if US-China trade tensions escalate further, if the safe haven bid returns with the kind of conviction it carried into January of this year, then the supply deficit and the geopolitical risk premium combine into something that takes silver well beyond its January high in the second half of 2026. The gold-to-silver ratio sits at approximately 50-1 right now. The historical average is between 40 and 60. Gold has already made its move. Silver, even after a 170% year-over-year gain, is still underperforming gold on a relative historical basis. That ratio compression trade, silver catching up to gold's move, is one of the most widely watched setups in the commodity market right now. Here is what this all means and why the $78 to $80 zone is the most important number you need to watch in the next 30 days. Silver did not go from $30 to $121 because retail investors got excited. It went there because NATO's stability is genuinely in question, because U.S. tariff policy created a physical market dislocation that nobody in Washington fully anticipated, because China executed a calculated economic counterpunch through futures positioning and supply chain leverage, and because institutional capital followed all of those signals simultaneously into the most structurally compelling commodity trade in over a decade. The fact that it is now unwinding does not mean the story is over. It means the story has entered its most consequential chapter. Every force that drove silver to $121 is still present in the market. The supply deficit is still in year 6, with no structural resolution in sight. The industrial demand from the green energy transition is still accelerating. The geopolitical uncertainty that pushed sovereign wealth funds into real assets has not resolved. It has deepened. The Fed is still behind the curve on a real inflation-adjusted basis, and China's strategic interest in owning hard assets rather than holding dollar reserves is a documented, multi-year policy direction, not a one-night trade. The $78 to $80 level will tell you everything. If silver holds that zone and begins recovering on volume, the second scenario, a sharp reversal toward 90, becomes the primary case. If it breaks on meaningful selling, the first scenario plays out and the patient money gets its entry. Either way, the third scenario, new highs later in 2026, remains structurally intact as long as the supply deficit persists and the macro backdrop does not fundamentally improve. The mainstream financial press will tell you tomorrow that silver fell because of risk-off sentiment, or technical resistance, or profit-taking after an extended rally. All of those things are true, and none of them are the real story. The real story is that the most important industrial and monetary metal on the planet is being priced right now by the intersection of NATO's fracture, Washington's tariff miscalculations, Beijing's strategic patience, and Wall Street's forced liquidation cycle. That intersection created the all-time high in January. That same intersection, in its current configuration, is creating the entry point that the smart money is quietly beginning to watch. Stay close to this number, $78 to $80, because what happens there in the next 30 days will define the silver trade for the rest of 2026.